I wasn't surprised about most of what you wrote, but I was intrigued about how you view real estate as an asset class. It's got the highest return, but
Yeah, so real estate's quite interesting as an asset class because I think most people don't really think of it as it is a levered secular growth asset. And your average person, I think, the average retiree, maybe not the institutions, but the average retiree, they would never go lever their stock portfolio 5 times, but you own a home and that is a levered investment. That's not saying it's a bad investment. I'm not saying that, but most people don't look at it in that light. So in the same way that you structure, that one should structure trend and counter-trend assets to balance the hawk and the serpent, the idea of including real estate in one's thinking about one's personal portfolio, I think, is really important because oftentimes your job is driven by the economic growth cycle. Your home is driven by the economic growth cycle. And then you're levering that exposure to the economic growth cycle. And then you're also adding stock exposure onto that. So the average retiree with or the average kind of working individual with a mortgage has tremendous exposure to the secular growth cycle levered in a
and there's an extraordinary percentage of baby boomers with mortgages.
Yes, yeah.
And the rest of their portfolios in an index fund.
And very few people think about this. And the concept at the end of the day that somehow that will be insulated. I mean, stocks dropped 86% in the Great Depression, and real estate dropped to the same degree. Now, in prior cycles, when interest rates were at 19% and were able to be lowered, that created a dynamic where real estate performed somewhat like a bond. Every single time that rates went down, it increased the affordability for people to buy bigger homes. So that provided a cushion for real estate. Well, when rates are at the zero bound, several bad things begin to happen. First of all, your 60-40 portfolio can struggle in the sense that your bonds are not getting as much benefit. But on top of that, your home price is not going to get as much benefit if rates can't be lowered.
At the margin.
At the margin, yeah. So I don't think people realize this. Rates where they are today, for us to get the same benefit on a bond portfolio, on a long duration bond portfolio, or the kind of same pickup in mortgages that we got after '08, the Fed would have to lower interest rates to negative 1.5%.
Ooh, don't say negative.
Right? To get the same benefit as people got based on where they lowered in 2008. I'm never going to say that's not feasible anymore because God knows what is feasible now. But I will say there are major social ramifications if they pursue a course like that.